The manipulation is finished. The game is over. The 40-year suppression scheme that has kept silver artificially cheap while the banks enrich themselves at your expense has finally reached its mathematical endpoint. For decades, we have watched the Comex operate as a price-setting mechanism that had nothing to do with supply and demand. We have watched the bullion banks dump billions of dollars worth of paper contracts onto the market at precisely the moments designed to inflict maximum pain on long positions. We have watched the same pattern repeat over and over again. Price rises to resistance. Massive sell orders appear out of nowhere. Price crashes. Retail investors panic. Banks cover their shorts at a profit. Rinse and repeat. Year after year. Cycle after cycle. We documented it. We screamed about it. We filed complaints with the CFTC that went into a black hole. And nothing changed. The manipulation continued because the manipulators faced no consequences. They had infinite paper. They had regulatory capture. They had the full backing of a financial system that needed silver to remain cheap to maintain the illusion that fiat currency was sound. But something has changed. Something fundamental has shifted in the architecture of the market. And today, I'm going to show you the evidence that the Comex manipulation machine has broken down. The gears have seized, the engine has failed. And the price of silver is about to reflect reality for the first time in 4 decades. Ladies and gentlemen, this is Silverstorm Daily, and what I'm about to reveal represents the end of an era and the beginning of a new one. Let me start with the data that crossed my screen this morning. The data that made me realize we have crossed the Rubicon. The Commodity Futures Trading Commission releases a weekly report called the Commitment of Traders. This report breaks down the positions held by different categories of market participants. Commercial traders, which includes the bullion banks, managed money, which includes hedge funds and speculators, and swap dealers, which is another category of large financial institutions. For as long as anyone can remember, the commercial traders have held massive short positions. They have been net short silver by hundreds of millions of ounces. This short position was the mechanism of suppression. Every time price rose, they added more shorts. They used their unlimited paper to overwhelm any buying pressure. The pattern was so consistent that you could set your watch by it. When silver approached key resistance levels, the commercial short position would spike. When silver fell back, the position would shrink as they covered at lower prices. It was a rigged casino, and the house always won. But look at the data from this week. Look at it carefully. The commercial net short position has collapsed to its lowest level in over a decade. The banks are not adding shorts into this rally. They are covering. They are reducing their exposure. They are running for the exits. This is not normal behavior. This is not what they do. When silver rips higher, the banks are supposed to fight it. They are supposed to dump paper contracts and crush the rally, but they are not fighting. They are retreating. And that retreat tells you everything you need to know about what comes next. Let me explain why this matters and what it reveals about the internal state of the bullion banks. When a bank holds a short position, they are betting that the price will go down. If the price goes up instead, they lose money. The larger the short position, the larger the loss. For years, the banks have been willing to absorb temporary losses on their short positions because they knew they could manipulate the price back down. They had the firepower. They had the coordination. They had the implicit backing of regulators who looked the other way. But absorbing losses requires capital. It requires margin. It requires confidence that you can ultimately win the trade. What we are seeing in the commitment of traders' data is a loss of that confidence. The banks are no longer willing to add shorts into a rising market. They are no longer confident that they can push the price down. They are looking at their risk models, looking at their capital reserves, and making a calculation. The calculation says that the cost of continuing the manipulation exceeds the benefit. The calculation says that the physical market has become so tight that paper games no longer work. The calculation says that it is time to get out before the losses become catastrophic. This is the moment we have been waiting for. This is the capitulation. The manipulators are surrendering the battlefield. They are not surrendering because they want to. They are surrendering because they have no choice. The physical market has overwhelmed the paper market. The demand for real metal has become so intense that no amount of paper selling can satisfy it. When a Chinese industrial buyer needs silver for solar panels, they do not want a futures contract. They want the metal. When an Indian family buys silver for a wedding, they do not want a paper promise. They want the metal. When a sovereign wealth fund diversifies out of dollars, they do not want an ETF share. They want the metal. And there is not enough metal to go around. The Comex registered inventory tells the story. We are at levels not seen since the 1990s. The vaults are being drained faster than they can be refilled. Every delivery notice is a demand for real metal. Every withdrawal is a subtraction from a shrinking pool. The banks look at these numbers and realize that if they keep adding short positions, they will eventually be asked to deliver metal they do not have. And delivery failure on the Comex would be the end of their franchise. It would be the end of their credibility. It would be the end of the paper silver market entirely. So they are pulling back. They are reducing their shorts. They are preparing for a world where the price is set by physical supply and demand rather than paper manipulation. Now, I need to walk you through the mechanics of how the manipulation works so you can understand why it is ending. The Comex is a futures exchange. A futures contract is a promise to buy or sell a commodity at a specified price on a specified future date. In theory, futures markets exist to help producers and consumers hedge their price risk. A silver miner might sell futures to lock in a price for their future production. A solar panel manufacturer might buy futures to lock in a price for their future consumption. These are legitimate hedging activities that serve a real economic purpose. But the Comex silver market has deviated far from this original purpose. The vast majority of contracts are not held by producers or consumers. They are held by speculators and financial institutions who have no intention of ever producing or consuming silver. They are trading paper for profit. And the bullion banks discovered long ago that they could control the paper price and extract profit from the speculators with a simple strategy. Here is how it worked. The banks would accumulate a large short position when the price was rising. They would sell contracts to speculators who were betting on higher prices. Because the banks had effectively unlimited credit and regulatory tolerance for concentrated positions, they could sell far more contracts than any normal market participant. They could overwhelm the buying pressure. At a certain point, when the short position was large enough, the banks would execute a coordinated attack. They would dump a massive number of contracts onto the market in a very short time window, often during periods of low liquidity like the overnight session or early morning hours. This sudden surge of selling would trigger stop-loss orders from speculators. As the stop-loss is triggered, more selling would cascade through the market. The price would collapse in a matter of minutes. The speculators who had been long would be forced out at a loss, and the banks would cover their shorts at lower prices, pocketing the difference. This cycle repeated hundreds of times over the decades. It was so predictable that traders gave it names. The Sunday night smash, the London fix attack, the Globex slam, the patterns were documented extensively. Statisticians calculated that the probability of these price moves occurring naturally was infinitesimally small. The evidence of manipulation was overwhelming, but the regulators did nothing. The CFTC opened investigations that went nowhere. The Department of Justice made noises about enforcement that never materialized. The banks operated with impunity. But here is the thing about manipulation. It only works as long as the paper market and the physical market remain connected. The manipulation depends on the paper price being accepted as the real price. When you go to a dealer and buy silver, the dealer looks at the Comex spot price and adds a premium. The Comex price is the reference. The Comex price is the benchmark. As long as that benchmark is trusted, the manipulation flows through to the physical market. Lower paper prices mean lower physical prices. The manipulation suppresses the cost of acquiring real metal. But what happens when the physical market starts to reject the paper price? What happens when dealers cannot source metal at the paper price plus a reasonable premium? What happens when the premium itself becomes so large that it reveals the paper price to be a fiction? We are in that moment right now. The premiums on physical silver have exploded. Silver Eagles are trading at $10, $12, $15 over spot. Generic rounds are trading at $5, $6, $7 over spot. These are not normal premiums. These are premiums that tell you the paper price is wrong. But the physical market is screaming that silver is worth far more than $77 an ounce. And the banks can hear the screaming. They know that their paper games are losing relevance. They know that the physical market is breaking free from their control. And that is why they are covering their shorts. They are not covering because they think the price will go down. They are covering because they know the price will go up. And they do not want to be caught on the wrong side when the disconnect becomes complete. Let me give you the specific numbers that illustrate the breakdown of the manipulation machine. At the peak of the suppression in recent years, the commercial net short position on Comex silver reached over 400 million ounces. That means the banks had sold the equivalent of 400 million ounces of silver that they did not own. To put that in perspective, the entire annual global mining production is approximately 800 million ounces. The banks were short half a year's worth of global production. This massive short position acted as a ceiling on the price. Every time the price rose, the losses on this position grew. But the banks could manage the losses because they could always drive the price back down. They had the firepower. They had the coordination. They had the psychological edge of decades of successful manipulation. Now look at the current numbers. The commercial net short position has fallen to under 150 million ounces. The banks have covered over 250 million ounces of shorts in the last several months. This is the largest short covering event in the history of the Comex silver market. And it has happened while the price has risen from $25 to over $77. The banks have been buying back their shorts at higher and higher prices. They have been taking massive losses on trades that they use to profit from. This is not normal bank behavior. Banks do not voluntarily take losses. Banks do not cover shorts into a rising market, unless they have no choice. unless they believe that the alternative, staying short, would result in even larger losses. The short covering is the admission. It is the confession. It is the acknowledgement that the manipulation is over. Think about what this means for the future of silver pricing. For 40 years, the Comex paper market has set the price. The physical market has followed. Dealers around the world have looked at the Comex price and based their transactions on it. But the Comex price was a manipulated price. It was a price designed to benefit the banks at the expense of miners, investors, and consumers. It was a price that bore no relationship to the true supply and demand fundamentals of silver. With the manipulation ending, the price discovery mechanism is shifting. The physical market is taking over. The Comex is becoming a follower rather than a leader. We are seeing this in real time. When the paper price dips, the physical premiums widen. When the paper price rises, the physical premiums narrow but remain elevated. The physical market is establishing a floor below which the paper price cannot go. The manipulation attacks that used to work no longer work because the physical buyers immediately absorb any artificial dip. They are buying the paper weakness with physical demand. The manipulators have lost their power to set the price. They can still cause short-term volatility. They can still engineer intraday smashes. But they cannot sustainably push the price below what the physical market will bear. The physical market will bear a much higher price than we have seen in the past. Let me address the skeptics who will say that the manipulation can never truly end. They will point to the history. They will say that every time we thought the manipulation was over, it resumed. They will say that the banks always find a way. They will say that the regulators are captured. They will say that the system is rigged permanently. I understand this skepticism. I have felt it myself many times over the years. But this time is different, and I can prove it mathematically. The manipulation depended on three conditions. First, the banks needed sufficient capital to absorb losses during the periods when the price went against them. Second, the banks needed sufficient physical inventory to make occasional deliveries and maintain the illusion that the paper market was backed by metal. Third, the banks needed the physical and paper markets to remain connected so that paper price suppression translated into real price suppression. All three conditions have broken down. First, the banks are capital constrained. We have covered the repo market stress in previous videos, the $17 billion injection from the Federal Reserve, the margin calls that are draining liquidity. The banks do not have the spare capital to absorb unlimited losses on silver shorts. Every dollar they use to margin a short position is a dollar they cannot use for other purposes. They are being forced to choose, and they are choosing to reduce their silver exposure. Second, the banks have run out of physical inventory. The Comex registered stocks are at historic lows. The LBMA inventories are shrinking. The ETF holdings are being drained. The banks cannot make deliveries because they do not have the metal. And they cannot acquire the metal without driving the price even higher. They are trapped between a paper commitment and a physical impossibility. Third, the paper and physical markets have disconnected. The premium explosion proves it. And when you have to pay $10 over spot to buy a silver eagle, the spot price is not the real price. The real price is spot plus 10. The banks can smash the spot price all they want, but if the premium widens to compensate, they have achieved nothing. The physical market has broken free. This is the endgame that we have been anticipating for years. It is not a prediction anymore. It is a description of current reality. The manipulation is over, not because the banks decided to stop. The manipulation is over because the market forced them to stop. The physical shortage is real. The capital constraints are real. The premium explosion is real. The short covering and the commitment of traders' data is real. All of the evidence points in the same direction. The suppression scheme has reached its mathematical limit. And when manipulation ends, price discovery begins. True price discovery for silver means a price that reflects the actual scarcity of the metal. It means a price that accounts for the growing industrial demand. It means a price that recognizes silver as a monetary metal, not just an industrial commodity. It means a price that compensates for decades of underinvestment in mining. It means a price that attracts new supply while rationing demand. Based on the fundamentals, based on the deficit, based on the inventory levels, that price is far higher than $77. That price is triple digits. That price is what silver would have reached years ago if the market had been allowed to function freely. Now let me walk you through what the end of manipulation means for the broader financial system, because silver is not an isolated market. Silver is connected to gold. Gold is connected to treasury bonds. Treasury bonds are connected to the dollar. The dollar is connected to everything. When you suppress the price of silver, you are indirectly supporting the dollar. You're sending a signal that hard assets are not valuable, that fiat currency is preferable, that the monetary system is sound. Conversely, when silver breaks free from suppression, it sends the opposite signal. It says that hard assets are undervalued. It says that fiat currency is overprinted. It says that the monetary system is fragile. The rising price of silver is a vote of no confidence in the Federal Reserve. It is a vote of no confidence in the Treasury. It is a vote of no confidence in the entire architecture of the post-1971 monetary order. The banks understand this. The central banks understand this. That is why they fought so hard to keep silver suppressed. That is why they deployed unlimited paper, regulatory capture, and media propaganda to convince the public that silver was a pet rock. But the suppression has failed. The price is breaking out, and the signal is being received around the world. Look at what is happening in the East. China has been accumulating silver at a pace that defies explanation. The Shanghai premiums are consistently higher than Western prices. Chinese industrial buyers are paying $80, $85, $90 per ounce, while the Comex says $77. They do not care about the Comex price. They care about securing supply. They are willing to pay whatever it takes to get the metal they need for their solar industry, their electronics industry, their military applications. The Chinese government has been building strategic stockpiles. They have been encouraging their citizens to buy precious metals. They have been laying the groundwork for a monetary system that includes gold and silver as reserve assets. The end of Comex manipulation is not just a victory for Western silver stackers. It is a victory for the Eastern monetary bloc that has been challenging dollar hegemony. Every dollar that silver rises is a loss for the banks and a gain for the nations that hold physical metal. The wealth transfer is already underway. The geopolitical implications are staggering. Let me give you the timeline of what happens next. In the immediate term, days to weeks, we will see continued volatility as the remaining shorts try to exit their positions. There may be coordinated attempts to smash the price one more time. The banks will use every weapon they have left to create the illusion that the suppression is still working. They will plant stories in the financial media about a silver bubble. They will trot out analysts who call for a crash to $30. They will try to shake the weak hands out of the market. Do not fall for it. These are the death throes of a dying regime. The banks are not attacking from a position of strength. They are attacking from a position of desperation. Every smash attempt will be met with physical buying. Every dip will be absorbed by Eastern demand. The floor is rising even as the banks try to push through it. In the medium term, weeks to months, we will see the complete transition of price discovery from the paper market to the physical market. The Comex will become increasingly irrelevant. The premiums will stabilize at elevated levels as the market adjusts to the new reality. We will see some dealers and refiners fail as the credit constraints bite harder. We will see consolidation in the industry as the survivors acquire the distressed assets of the failures. We will see the first mainstream media acknowledgement that something has fundamentally changed in the silver market. They will not call it manipulation ending. They will call it supply chain disruptions or unexpected demand. But the effect will be the same. The narrative will shift. Silver will no longer be dismissed as a fringe asset. It will be recognized as a strategic resource. In the longer term, months to years, we will see silver achieve prices that would have been considered impossible a few years ago. $100 per ounce is not a ceiling. It is a floor. $200 is achievable. $300 is not out of the question if the monetary crisis accelerates. The gold to silver ratio, which has been artificially elevated for decades, will compress toward its historical norms. If gold reaches $3,000, $5,000, $10,000 per ounce, silver will follow with a multiplier effect. The percentage gains in silver will exceed the percentage gains in gold. This is not hype. This is mathematics. When a manipulated market becomes a free market, the repricing is violent. The decades of suppressed price get unwound in a matter of months. The investors who position themselves before the transition are the beneficiaries of a once-in-a-generation wealth transfer. This brings me to the most important question. What should you do with this information? How do you position yourself for the end of manipulation and the beginning of true price discovery? First, you should own physical silver, not paper silver, not ETF shares, not unallocated accounts. Physical metal in your possession or in an allocated, audited vault that you control. The paper market is where the manipulation lived. The paper market is where the counterparty risk resides. As the paper market loses credibility, the paper claims on silver will be exposed as the illusions they always were. The only silver that matters is the silver you can touch. Second, you should continue to accumulate despite the higher prices. I know it is psychologically difficult to buy at 77 when you remember buying at 25, but 77 is cheap compared to where we are going. The end of manipulation means the price is finally real, and the real price, based on fundamentals, is much higher. Every ounce you buy today is an ounce that you do not have to buy at 100 or 150 or 200. Third, you should ignore the noise. The financial media is going to become increasingly hostile to silver investors. They will call us speculators. They will call us hoarders. They will try to blame us for the shortages that the banks created. They will demand government intervention. They will propose taxes on precious metals transactions. They will do everything they can to protect their fiat masters. Do not let them shake you. The fundamentals are on your side. The physics are on your side. The mathematics are on your side. The history of sound money is on your side. Let me tell you a story that illustrates why the end of manipulation matters on a human level. Last week, I received an email from a viewer. He is a retired firefighter in his 60s. He started buying silver in 2010 after watching a documentary about the financial crisis. He bought a few hundred ounces and kept adding over the years. His family thought he was crazy. His financial advisor told him to sell and buy index funds. His friends made jokes about his shiny rocks. For 13 years, he watched the price go sideways while his conventional investments grew. He doubted himself many times. He wondered if he had made a mistake, but he held on. He kept stacking. He trusted the fundamentals even when the price action said he was wrong. This week, his silver position is worth more than his entire stock portfolio. He is not rich by Wall Street standards, but he is secure. He has real wealth that cannot be printed away. He has metal that cannot be diluted by a central bank. He has independence. And he has vindication. His family no longer thinks he is crazy. His financial advisor has stopped calling. His friends want to know how they can buy silver. The manipulation ending is not just about price charts and financial analysis. It is about justice. It is about the little guy finally winning against the big banks. It is about truth defeating lies. It is about the market working the way it is supposed to work. The end of Comex manipulation is a historic event. It marks the failure of a 40-year campaign to deceive the public about the true value of silver. It marks the beginning of a new era, where price is determined by supply and demand rather than paper games. It marks the transfer of wealth from those who created artificial abundance to those who recognized the real scarcity. But it is also a warning. The banks did not lose willingly. They lost because they ran out of ammunition. They lost because the physical market overwhelmed their paper defenses. They lost because nations like China and Russia refused to accept a rigged price. The forces that defeated them are now demanding their due. The physical silver is moving from west to east. The economic power is shifting. The monetary order is changing. Those who understand what is happening are positioning themselves for the new reality. Those who do not understand will be left holding devalued paper claims. I want to be very clear about something. The end of manipulation does not mean the end of volatility. It does not mean a straight line up. The transition from a manipulated market to a free market is messy. There will be days when the price drops $5. There will be weeks when it seems like the old suppression has returned. The banks still have resources. They still have allies in the media and the regulatory agencies. They will fight a rearguard action to preserve what they can of the old system. But the trend is clear. The direction is unmistakable. The suppression is ending because it has to end. The math demands it. The physics demands it. The market demands it. And no amount of paper can change physical reality. For those of you who have been with this channel since the beginning, you know that we have always focused on the fundamentals. We have always said that the manipulation would end when the physical shortage became severe enough. We have always said that the paper price would eventually reflect the physical reality. That day has arrived, not because we wished it, not because we predicted a specific date, but because the mathematics finally caught up with the manipulators. The silver market is normalizing, and normalization means a much higher price. Let me leave you with a thought about what silver represents in the broader context of monetary history. Silver has been money for 5,000 years. It has outlasted every fiat currency ever created. The Roman denarius was silver. The Spanish real was silver. The American dollar was defined in terms of silver until 1965. Throughout history, governments have tried to replace silver with paper. They have always failed eventually. The paper burns. The silver remains. We are living through another cycle of this eternal pattern. The fiat experiment that began in 1971 is reaching its endgame. The debts are unpayable. The currencies are being printed into oblivion. The trust is eroding, and silver is reasserting its role as real money. The end of Comex manipulation is not just a market event. It is a historical event. It is the silver market reclaiming its rightful function as a store of value and medium of exchange. The banks tried to demonetize silver. They tried to turn it into just another industrial commodity. They tried to break the connection between silver and money. They failed. This has been Silverstorm Daily. The Comex manipulation is over. The paper price is converging with the physical price. The banks are covering their shorts. The vaults are draining. The premiums are exploding. The East is accumulating. The West is waking up. Everything we have discussed for years is happening in real time. The only question is whether you are positioned to benefit or whether you will be a victim of the transition. The choice is yours. But the window's closing. The metal is disappearing. The price is rising. And the manipulation is finished. Like, subscribe and share this video with everyone who needs to hear the truth. The silver crisis is here, and the crisis is the cure. The market is healing itself by destroying the disease of manipulation. We are witnessing history, and history favors those who hold real assets. See you in the next report.